Commercial bank lending on a rolling averages dropped by 105 billion in the last 2 weeks of March versus 4 weeks prior. And I'm like, wait, what's going on? You know, well, it's the greatest drop in terms of dollars being lended out by all banks. You got the big four, which of course is Chase, Bank of America, Citibank, Wells Fargo. You know, you got the big four, and then you've got all the rest of the regional banks and Silicon Valley Bank, and a lot of banks were in the middle of all that. You saw PNC Bank, you know, big banks there. You take all of that, and all of a sudden the amount of lending they're doing drops. Well, why? Well, number one, regulations. Number one, uncertainty in the market. And number three, risk. They're seeing risk downstream. So forget what you hear from politicians saying life is good, life is bad, life is not so, it's a little of everything. It's okay, it's neutral. Forget that. When the banks are looking forward, just like when insurance companies start underwriting looking forward, and they say we're doing this, they see risk. So step away from the headlines and say to yourself, do I have what I need? Because what has happened here is mid-stage businesses are being pinched the most because they usually have the lower asset base that they can offer some collateral. The smallest businesses, they end up in a thing where they have to do PGs. And what a PG is a personal guarantee, which says, hey, Tom, you've got a business there. Maybe we're willing to loan you 100 grand. And that would be like a big, fully outfitted truck, perhaps. You know, it could easily be 100 grand. If you're in construction and you have all these things, and it's a big 2500 series, 250 series truck, crew cab, and all the things that you need on that, that truck can easily come to 100 grand. So vehicle loans at 100 grand. But if you want more than that, they'll say, how much equity is in your house? Do you have a boat that's paid for? Yeah, I got a $500,000 boat. It says, okay. Well, they want a PG, personal guarantee. So that's the small businesses. So the PGs are kicking in sooner from what I could read just in the last couple of weeks. And businesses that are at the banks right now are facing pinches. Well, we'll only loan you this much, and this is the rate, not this rate. So the low rates of a year ago is over. So what's very interesting is said this is the biggest drop in Federal Reserve history dating back to the origin of this particular tracking metric, which was in 1973. And in 1973, what happened in 1973? The Vietnam War wasn't fully reconciled yet. Number one. Number two, JFK had barely been 10 years since the assassination of JFK. You know, we lost Martin Luther King 5 years prior. So we're talking, this goes back a ways into history. We're talking 50 years or more, and this is the biggest drop in 50 years, which shows you the significance of it. So what's in it for you and me? Remember I cautioned you and all small businesses a couple weeks ago talked about, hey, to protect yourself, always have an account with maybe a big four, and then account with your regional bank. If you're using with a regional bank, and I'm going to give a couple names out because I know them in Texas. I came from Dallas, and I know they were good. One was Veritex Bank. I know the guys out there that used to do business loans, very easy to deal with, but they're a regional bank, you know, a very regional bank. And banks like that have that opportunity. I said, buffer your risk. You know, mitigate your risk, put them both side by side. And the one thing you can do is you can have a big bank you deal with, and then you could have a regional bank. And you get a lot of services from your regional bank and hope that they don't start sniffling and catch cold the way Silicon Valley Bank did and then go over the waterfall with your regional bank where you can get a lot more services. And then your big bank, maybe put your other checking account there and put your rent account. Just pay rent out of that. But that way you've got two accounts, so if you have to jump one to another to mitigate banking risk, you could do it. Well, guess what? If you have two relationships like that, often you can go and you can get mitigate your, not only your banking risk, but your loan risk. And so what's very interesting here is that this gives you the opportunity to follow your own momentum of your business, number one, and number two, have things in place that are going to help you, you know, when the chips are down and when something happens. And so Quality wins. Running a quality business wins. Showing that you are very efficient with your operating expenses wins. Showing that you are focused on net cash burn, if you're early stage, that wins. So that's what's going on in bank financing. And it's hard to tell whether the banks are being pinched by the Fed so they can't get as much money, or is it the banks increasing their credit? Well, I've seen both. The banks are doing tightenings of credit, but the tightenings of credit can also be if they can't get access to full lines. So if they can get access to less capital, they reduce they tighten up things on credit so that only the best of their customers, the strongest credit, is able to get it. So that's what's going on in banking. There's a lot more we could dive in on, but it's just kind of a little check engine light, and make sure that if you need to get loans from your bank, you walk in and you understand how to mitigate and position yourself accordingly. Then I decided to go look at the other end. Well, let's go look at VC funding. Well, guess what? Global venture capital funding in Q1, it slipped to $76 billion. That is a 53% decline year over year from the $162 billion that was invested in 22. So did I mention that it's a tighter environment for businesses trying to get financing? Yeah, I did. And again, quality is going to win. The great companies are still going to get their venture capital, no problem whatsoever. The great companies. The weaker businesses that maybe they would have got maybe a very small Series A, find a venture capitalist that's going to do a little bit of a test. Yeah, maybe that's going to be tougher. But the great companies are still going to be in line. They're still going to be getting all the things that they need. Whereas the riskier companies, or the ones that are less established, are going to have issues. But you know what? So it's going to be harder for earlier stage startups, but the more established companies that are hitting their marks, getting their traction, they're still going to get it. But what it says is the story may sound familiar for the established organizations that are going to the banks and the early stage company that are going back for more venture capital in the natural round by round growth from seed to Series A to Series B, where you have an idea, you put your skin in the game, some of your money, you get seed capital from others, you get a Series A when you get traction on first customers, get a Series B where you're starting to reduce the cash burn, you can almost see a point where you're actually going to be cash flow neutral. That's a natural stepping stone. Well, guess what? The better companies get access to it, because VC funding is down 53% in total dollars year over year. So there you have it. Again, quality wins, efficient cash burn wins. If that's a familiar story, guess what? Good, well-run businesses are going to be in good positions to get cash.